Every investor dreams of the same thing: predictable income, strong tenants, and a property that quietly appreciates while they sleep. A sale-leaseback delivers exactly that: predictable income and reliable tenants, and built-in growth. So instead of chasing tenants, you buy one that's already locked in. Day one, rent flowing, no surprises. It's the calm, calculated play in a noisy market. So why would an investor buy this kind of building? What do the real numbers look like? And how do they build wealth long after closing? So the building's a 20,000 square foot industrial building in Burlington, 30 years old, 18-foot clear, 3 truck level, 1 drive-in, 15% office, 3 per thousand parking. Functional, not fancy, and in a tight industrial market where vacancy is always in demand. The owner sells to release equity and leases it back for 10 to 15 years. That's your dream tenant, an established business literally betting on its own longevity. Now for the math. Your purchase price is $7.5 million. The lease rate is 15 net, with 2% annual increases year over year. So year one's net rent is $300,000. You have a 4% return on day one. And here's where those small 2% annual bumps start to matter. Your income will climb steadily each year. By year 10, you're collecting about $358,000. Over the term, $3.28 million if it's a 10-year term. Your annual income is up 16% before you even account for appreciation. That's steady, predictable income for the buyer and seller turned tenant, manageable rent growth that typically stays below market by the end of the term. Translation: if the tenant leaves or renews, the tenant's rate will increase. So why would an investor accept a 4% cap rate today? Well, certainty plus growth beats speculation. Locked in income, you collect about $25,000 a month immediately, and it increases over the term. There's no vacancy, no leasing commissions, no downtime. You have tenant stability. This is an established tenant who's now taking on a 10 to 15-year lease, which means a very low turnover risk. That same operator who built the business here is now guaranteeing your rent. Appreciation and escalation. Burlington industrial values have historically appreciated 2 to 3% year over year. At a 2% increase, your $7.5 million asset becomes roughly $9.15 million in 10 years. If that same building were sold vacant, those numbers would be even higher. Layer on the rent escalations and you're collecting around $3.28 million total rent over 10 years. Leverage amplifies those returns. Finance 60% loan to value, about $4.5 million in debt, and invest $3 million cash into the asset. At 6% interest, 25-year AM, annual debt service is about $375,000, $31,000 a month. Yes, we all know lenders who can beat that rate, but let's keep the math simple. Now the question is, why would an investor buy this if year one returns are negative? Because the total gain doesn't just come from one source, it actually comes from three. That's what makes it a long-term wealth strategy, not a quick flip. You get equity from principal paydown. Every payment chips away at the loan balance. A built-in savings plan increases your ownership stake year after year. Appreciation. Property values rise over time. In this case, even a modest 2% annual increase adds roughly $2 million in value on your $7.5 million building. A strong return on a $3 million cash investment. Cash flow growth. Early cash flow may be tight, but those 2% rent bumps compound each year, turning thin margins into positive cash flow by midterm. Combine principal paydown appreciation and growing income, and your total return becomes far more attractive than early year numbers suggest. Leverage lets you capture appreciation on the entire $7.5 million asset with only $3 million invested. That's the quiet power of smart financing. Then there's tax efficiency with the capital cost allowance. Investors in Canada can also claim this allowance. It's basically a tax depreciation. Since buildings wear out over time, the CRA lets you deduct a portion of the building's value each year. That deduction reduces taxable income, meaning your after-tax return is often higher than the headline cap rate, a quiet, steady advantage that keeps long-term industrial assets attractive. Of course, not every deal is champagne and checks. At 4.5% cap, your margin is very tight, and interest rate bumps can very much affect your value. Remember, it's still a 30-year-old building. Roof, HVAC, and asphalt will all need attention within the next 5 years. Smart investors budget a $50,000 annual reserve so those surprises don't eat their yield. That discipline separates professionals from speculators. The strategy is simple: steady income, compounding appreciation, and smart leverage. Hold 10 to 15 years, refinance as equity builds, let rent escalations pay down your debt faster. When the lease renews, you're negotiating from strength with a proven tenant in a high-demand market. In other words, steady income, compounding appreciation, and smart leverage, the holy trinity of boring but brilliant CRE. I'm that commercial realtor. If you're an investor looking for predictable returns with real upside, a sale-leaseback is a quiet power play hiding in plain sight. Before you deploy capital, let's run your numbers and structure it right. Because in commercial real estate, boring buildings with strong tenants make the loudest profits. If you found this breakdown helpful, hit subscribe and follow for more no BS insights into commercial real estate. Because smart investing starts with smart information.